is not feasible, in part because there are differences in terms of the level of income and development in countries. And one point to Santiago's idea about the lender of last remarks about lender of last resort and insurance. I think the easy cases are those of the countries that are well behaved, to put it in Alan terms, the innocent bystanders, but one has to think about the reckless drivers. One has to think about how to insure them. I mean, if we're making the analogy and extending it to the car insurance, they are insured as well. They are insured as well. Maybe they pay a higher premium. Maybe they can lose their driver's license. But the IMF has to think about that. The IMF already has a group, actually. I'm participating in that group, thinking about those cases, how the IMF has to deal with those cases.
Okay. The last question, Shekhar, and then last question.
Thank you, Jay. I want to juxtapose the comments of several of the panelists and then put this question to Professor Zadeo. And it actually also harks back to Guillermo Calvo's opening speech about the lender of last resort. The notion that Santiago Levy put forward, that this is a crisis that emerged in the core and not in the periphery, and Alan said that too. What would happen if the next crisis actually emerges not in the core but in the periphery? Alan's point about what were we thinking about and corrections that have been made to that. And then Professor Zadeo's comments about the pessimism that he sees, essentially. How deep a crisis do we have to go through? And again, I'm reminded by your First World War, and then we had to have the Second World War before we actually got to the Bretton Woods institutions. What is the nature of the crisis and the constraints you mentioned about the unemployment in the US, which is creating a deep tension on reform? How much will we have to go before we actually get to the kind of reforms we need?
Thank you. So we go to the answers by here, order of appearance. Okay, François.
Okay, maybe I'll take up on the question about the lessons from the European experience about governance. And I would say that there are successes and there are failures. Successes is, I would say, in the number of regulations that the European community was able to pass, and which are doing a very good job in improving all the relations among countries, competition, on emission, possibly on some environmental rules, etc. This has been successful. Now, in some areas, regulations are not possible. Yet, we can say that, by and large, there has been some coordination, and this is working satisfactorily. There is no common tax rate on savings, yet they are more or less at the same level, simply because everybody knows that if there is a free rider, then there will be a political uneasiness in the community. When we look at macro policies, again, we have good things and bad things. We have good things in emergency situations. It is true that there is a common reaction and there is a will to coordinate. When the pressure is slightly lighter, then this will to coordinate disappears. And it is true that we may find some difficulties in the future within the community, with a couple of countries being high savers and several countries being high dissavers. Global imbalances, which we observe in the world, to some extent also may exist in the EU, and I don't know exactly how this will be solved. At the same time, there is enough political will to know that there will be a solution, and this may be the difference in the comparison with global issues.
Okay, Padma?
The question on the separation of the commercial banking and investment banking, I think the idea in the prevalent mode of thinking of the regulators is it doesn't make sense to break up commercial banking and investment banking because even if you break them up, the investment banks by themselves will again tend to take too many risks. So you're not going to be able to control investment banks as such if you prevent them from receiving public deposits or household deposits, which are in the United States regulated by the Federal Deposit Insurance Corporation and by the Federal Reserve, which requires that you maintain adequate capital backing to your commercial liabilities of the reserves, the deposits which you receive. This idea is similar for investment, the joint banks, in the sense that just as commercial banks are regulated, these joint banks again will be regulated by new regulation, by capital adequacy requirements, and by the threat that they will be broken up if they become too big to fail and become too risky. But nobody now agrees that Citigroup or Goldman Sachs should be broken up. There are 8,000 community banks in the United States across the country, and they are essentially commercial banks. So there is a diversification there already.
Okay, Santiago, thank you.
Yeah, on the question of the size of the coverage that the IMF should give, clearly the IMF would not provide unlimited coverage. It would have to be established by X times the size of the quote of the respective country. The point is that this would be known ex ante up to what is the amount the countries could draw, up to a certain limit, but this would not be known ex ante, be known by everybody. And the moral hazard issue is you've got to pre-qualify countries, and you would pre-qualify countries on the basis of good policies. So the point here is that not everybody would have a right to that particular coverage. That leaves a problem that Mauricio referred to, which is what do you do with the reckless drivers? And in a way, this might sound tough, but you want the reckless drivers to internalize the costs, not to be able to access these facilities. And a very important part of the proposal, which I didn't dwell upon sufficiently, is that also has implications for the role of the MDBs, not the IMF, for the actual multilateral development banks, because you don't want them to, behind the doors, be also do countercyclical lending. So if you close the doors on countercyclical lending by the MDBs, and you have the right incentives for qualifying for the insurance, then the cost of being a reckless driver is increased, but more importantly, even if you are, the contagion generated by your behavior is contained and is mostly internalized within your own country.
Thank you. Alan? Thank you, Leo. Alan?
Yeah, a couple of remarks. Lessons from Europe, Andy. I guess Europe confronted earlier the question of what to do about cross-border financial regulation, since it is central. Maybe some of that didn't turn out in an ideal way or a good way, but in the crisis, there are at least some procedures in place to deal with things like Fortis and some of the other cross-border banks. Maybe that's something that can be drawn upon. I think Europe's also maybe been a bit stronger in its antitrust stance, and one of the problems of how do you get too big to fail banks is that you're not being strong enough in your antitrust position in terms of saying we're not going to let them get that big in the first place. So the mergers that led to Bank of America and Citigroup ending up with $1 trillion or $2 trillion balance sheets, maybe that wouldn't have happened with a more European approach to antitrust, and I'd like to see a bit stronger approach there in the United States. So, maybe either preventing Citigroup getting that big or maybe enhancing the procedures you have on hand to deal with an autopsy. Maybe those are two things we could learn from the Europeans. But I don't think, turning to the question about regulation, I don't think it's entirely hopeless. I mean, there are some good ideas out there percolating amongst some leaders. I'm thinking here, particularly the UK, people like Mervyn King and Adair Turner, or also the BIS. I think there's a much more aggressive stance coming from some of these people about how much regulation you need to do, how you can put tighter capital adequacy ratios on, or leverage caps or other things. The big vacuum is in Washington. I'm not hearing the same kind of aggressive talk about macroprudential regulation and explicit policies from the Fed, the Treasury, the White House, and I think that's the missing link.